appreciate being able to see, whereas before we're just being told. And wow. Yeah. Did you get a chance to read all of this? Oh, let's just say it's not going to end well.
I have too many Zoom, I have too many email passwords that are.
I
had to get the right one.
pages is okay. The summer of it. It's yeah. On a positive note, there's no today. Yes. I've actually now since I talked to Dave, but the improvement is good.
No, we got snowed in, we had snowed in.
Yeah, I'm helping him come up with check your email.
So are the auditors on their phone? No, they are, no, they just do audit all. Yes, no, yeah, we have executive session after this, so. Yeah, you'll have time.
Hurry up and wait. Hurry up and wait.
Yes.
I was going to run to Mitchell's, and I thought, no, I'll get here early just in case. Should have gone to Mitchell's. And fighting this cold that's going around. I took a little bit of a nap, and my daughter woke me up when she got off the bus and said, "Mom, you're going to be late." Okay, that'll be great.
I think I'll just go in and,
Well, I was reading this today, and then I was looking at all the policies and making notes on all the policies. And my friend called me and said, "Hey, you're coming grocery." I said, "No, I want to, but today I'm just going to do this because tomorrow I'm not going to look at it. I'm not going to think about it. I'm not going to touch it."
Brady, is it working now?
Let me try it. Still says so.
Okay, as my grandson used to say, let's get this party started. Right. Right, get the party started.
I hate to do this to you, but I think I need to.
I was just saying, my little heart, they're not excited about Christmas this year.
I'm gonna start cleaning again.
Oh, lucky.
Is there okay with that? If you sign off.
Every once in a while.
Yeah.
Do you want me to sign off?
Let's go.
Let me go and see if I can. Well, let me see what's your
So this year they started.
I think I need to have you,
Competition
drop off, we need to drop off in this.
And so that's.
Okay.
Okay.
I'm gonna end the meeting.
And we just wanted to see they won for sure. Cool. Against Timberlake, Lakewood, Lightning. They walked away with the first show competition. So these are all of them are they are rowing each other.
That's third through eighth grade.
And yeah, so now we're
Brandon, we're gonna make you a host.
Okay.
Okay, that way you should be able to
You're
share your
set
screen.
me host, and I should be able to share the screen. Let's just
Yeah.
divide
So.
my screen off. I share. I should be able to. Can you see the financial report now?
Yes, yep.
Okay.
And so, yeah, I think I'm gonna make you just, really grow a program and. See if I can sample video.
Yeah, no one cares to necessarily see my face.
Okay, and everybody just that you, I lost you.
I
We'll
know,
click on the-
right?
click on
Yay.
There.
That's awesome.
Yeah, so we just do draw some.
Click on that again,
Yeah,
yeah.
okay.
Now minimize this, hit that minus button.
We're gonna minimize you.
That's really great.
Okay.
Practice, practice.
And I'm gonna move that out of the way so we
There
can
we
see the
go.
financials. Okay, sorry. Every Sunday. All right, we are a little late, probably, but are we set?
Set.
If everybody, I'd like to call this meeting to order, and it is at 4:05, and I'll ask people to stand for the Pledge of Allegiance. I pledge allegiance to the flag of the United States of America and to the republic for which it stands, one nation, under God, indivisible, with liberty and justice for all. Thank you. I will need a motion for approval of the agenda and a second.
Madam Chair, I make a motion that we approve the agenda.
Okay, I have a first.
Second.
Second, first by trustee Rutledge, a second by trustee Brown. All those in favor say aye.
Aye.
Thanks. I will go ahead and, let's see, I should actually, excuse me for just a second, because we'll just give Brandon a little bit of face time before we start. Brandon, I'm going to bring, not me, but you. I'm going to go ahead and let you sort of introduce yourself and go ahead and, if you would want, and I think that will work because you'll be there so we can still see you, but you can also scroll through.
Okay.
You can also scroll through the financials.
Very good. All right, so hopefully you can hear me all right. As you indicated, my name is Brandon Blair, and I'm a partner in DeCory Blair and Teague, your district's audit firm. Joining us, at least as of now in silence, just so that we don't have background noise interfering with it. Brandon Tregellis, who's an associate partner with our firm, was also actively involved in the audit this year as well. He is a participant in this meeting, but he's muted at this time so that we don't get the interference with the sound. So I guess again from that perspective, just a quick little introduction. We're, as a firm, we audit governmental entities throughout North Idaho, and we've been working with the district for a number of years, and this is what we do. We are auditors. Obviously, within our firm, we do a lot of other CPA type services, taxes, bookkeeping, etc. But our team, my team specifically, we're almost exclusively audit related. So that's just a quick little introduction to who we are, and I'll let you go from there.
All right, so I guess, would you like to, normally you sort of take the role of running through the audit, and I don't know, before you usually run through, obviously go to the findings of the audit. Do you want to kind of flip through, as we have done in the past, I think, of sort of describing the audit and then seeing if other board members have any particular questions and how best to proceed.
Absolutely, yeah, I just wanted to make sure that I wasn't jumping in too quickly there. So I'll go ahead and, from this point, I'll just kind of take the ball and run with it, and go through the audit report here, the financial report, focusing on what's included in the report, and then of course our reports that we provide. So I'll go through there. As Margaret just mentioned, we have had some detailed conversations with board representation and management throughout the audit, and we went through in detail the opportunity to go through the financial statements. Obviously, we want the entire board to have the opportunity to ask some questions, which we'll certainly get to, but just want to make sure we hit some of the high points, and then I'll do best to respond to any questions you might have. So with that, I'm going to kind of skip through the financial report. First, I want to look at the what's the table of contents, okay? And just to provide you with a brief summary of what's included in the financial report. We start with the independent auditor's report. That's the primary report that we provide. There are two other reports at the end that we also do, but this is the primary report related, not specifically, but focuses on the financial statement audit itself. We'll look at that briefly. And then, like I said, at the end, there's a couple of compliance reports that we also include, and there's a schedule that goes with that. And there's a lot of stuff in between, and that's all the district's responsibility. There's the district's financial statements. It starts off with what's called this management's discussion and analysis, and that is an opportunity for the district's management to provide a brief summary of the financial condition and what kind of took place, kind of hitting some real high points, and also some comparisons to the prior year, so that you can kind of see what overall what the financial condition is, and results were compared to the prior year, because the financial statements everywhere else is primarily on a single year presentation, just the current fiscal year. And then the basic financial statements are comprised of two different presentations. There's a district-wide that's kind of all-encompassing, holds everything together, has a presentation that's what we call more full accrual, includes all assets, current and non-current, and all liabilities, current and non-current, with the difference being referred to as net position. And then there's these fund statements that are primarily the general fund, but then you've got a lot of other funds that get grouped into this, what's called non-major governmental funds. And then there's the footnotes to the financial statements from 21 through 50. There's a lot of information in those footnotes. I won't hit a lot of that, but obviously if you have any questions, I'm happy to address them. The required supplementary information that is again, as it sounds, required to be included with the financial report. There's budgetary information. There's these schedules related to pension plans and other post-employment benefits. That's kind of what we start with in here, and then there's some accompanying notes. And when I say we start with, we assisted in preparing the financial statements and the accompanying footnotes and schedules, but they are management's, they're the district's financial statements. They're your information. We just helped prepare them based on information provided to us. And then as we continue on, there's what's called other supplementary information. I mentioned those other governmental, non-major governmental funds, and you've got several of them. It's broken out in detail by individual fund for local or state and federal funds. And then we get again to the end, the compliance report. This is the other section. This is what we get to provide at the conclusion of our audit as the results go. And like I said, there are two. One is dealing with internal control over financial reporting. That's primarily on the financial statements and how we conduct the audit. and then the reporting that goes with that. And then there's also a separate report dealing with federal awards. Whenever an entity expends more than $750,000 in federal funds, there's a separate audit that's referred to as a single audit that focuses just on federal dollars. And that's what this last report is in reference to. All right, any questions so far?
It doesn't look like it. I don't know.
Okay,
Can you
sounds
see,
good.
can you
So
see us?
the first report, the primary report, independent auditors report, just again summarizes what we did. We conducted an audit as you would expect. It provides, here's the opinions. It's a clean opinion. The financial statements are fairly stated in all material respects. The basis for our opinions, which is really we conduct the audit in accordance with professional standards, and based on the results of that audit, we issue an opinion. And the audit requires that we go through and identify what we have to understand your controls, your control systems, control environment, document that so that we can properly design and then conduct the audit. And then as a result of that, we issue another report related to internal control, but not an opinion. We don't audit internal controls. We don't necessarily even test internal controls. But what we do have to make sure that we understand your controls and your control environment sufficient to be able to properly design the audit procedures to be performed. And then we also issue a report if we identify any what are referred to as significant deficiencies or material weaknesses in internal control. And we'll look at that as well. There is something in here just to kind of take note of. There's a new standard that became effective for the district dealing with leases. Did not have a significant impact on your district. It changed how it's presented. You have a capital lease for some equipment that is reported as now it's not presented as a capital lease because at the end of the lease it transfers ownership to the district. It's referred to as a financing arrangement, a finance purchase arrangement under the new standards. But the amounts and as they've been presented previously are essentially the same. So but if you do in the future enter into new leases, there are additional things to consider when those things take place, if they take place and they're significant. Okay, responsibility of management. I've already stated this. Management has the responsibility for the financial statements. Our responsibility is to conduct the audit in accordance with professional standards and issue an opinion. This is a new format. The way that we conduct the audit, the standards that we follow did not change in terms of what the audit standards require us to perform, but the report has a lot of additional information in there as to what is comprised of an audit and what things are taking place throughout the audit and our responsibilities, again, in greater detail. But it doesn't change. It did not change how we conducted the audit. And then again, mentioning that required supplementary information, the budgetary comparison schedules, and then the other supplementary information. And that is again the primary report in a very brief overview of what's in there. So before we jump to the other compliance reports, just to hit a couple of high points on the financial statements themselves, just so that you can kind of familiarize yourself with how it's presented. So as I mentioned, there are two types of presentations. There's the government or the district-wide financial statements, which include all assets of the district, current and non-current, and all liabilities, current and non-current. And there's information that's presented on these first two statements that is not presented on the other fund statements, which is more consistent with your budget. And the reason for that is your budget is focused, and the fund financial statements is focused on the current year's activity. Current year focus, current assets, current liabilities, current revenues and expenditures, and the long-term stuff is not as critical for the fund and budget purposes. So that's why the two different presentations. Without going through each of the financial statements themselves and the footnotes, are there any questions that you have at this time? Specifically on the financial statements and the footnotes.
I think, Brandon, the one thing that might be worth going over, and I'm looking at the notes, because of the notes, actually, there's a lot of really critical information. I mean, it's always, it's one of those, when you get a quarterly report or whatever, there's a lot of things hidden, or a lot of information in those notes. The one that might be helpful, and I'm just scrolling through the document that I have, it might be helpful to discuss, I think the one place that I always see, so I'm jumping ahead and there may be some other notes there, but I'm thinking the notes, I think it's 12, 13, and 14. There's a lot of information there regarding Percy, the sick leave, pension, all those different things. And I just wondered if, let me find the first note and which one, but is there a way to sort of describe those in a little bit easier? Because there's a lot of information there.
There is a ton of information in there. So quick, you mentioned footnote 12, which
it's
the
actually
biggest thing in footnote 12.
It was
actually stick out is as I mentioned, the lease is the finance purchase agreement, but really footnotes 13 and 14, I think, is the real complex information. And what it's referring to is the footnote 13. Footnote 13 deals with what are called other post-employment benefits, okay, and OPEB for short. Hopefully, I've done a highlight. Can you see that with my cursor?
Yeah. Yes.
Okay.
Yeah.
So just to kind of help put that together. So what you've got there, there's two different things that the district has that you're actually required to participate in related to these other post-employment benefits. One is what's referred to as a sick leave plan, and then the other is an insurance plan. The sick leave is when individuals or employees are able to accumulate sick leave, and when they retire, if they have sick leave left over, they're able to sort of roll that value into the Percy plan, and there's some additional benefits they get from that. And all of the information that goes with that and that sick leave is primarily determined based on information that comes through Percy and state statute. So the only control you have is your employees, how many district employees you have, and obviously then the pay scales that go with that. But as far as who qualifies and participates, it's primarily driven by state statute legislation and what your contributions are. And in fact, over the last couple of years on the sick leave plan, there has been sort of a hold or a freeze on any contributions. So because it's been in a positively funded position for that plan. So there's no required contributions currently. That will change or has changed as of now, but as for the fiscal year that we're looking at, there were no contributions for that. Then the insurance plan is related to retirees. Once they retire, they're eligible to stay on the district's medical plan. They have to pay for the premiums, but because of that future benefit that they have available to them, it's another post-employment benefit that there's that an actuary comes in and calculates what your estimated liability is and how those benefits are earned over time, over the expected service life of the individuals. And the net pension liability is described in footnote 14, and that's the pension plan. And the pension plan is of course for all participating governmental entities, but the standards require that you record your proportionate share of the pension liability or net pension liability based on your contributions to the plan compared to every other participating entity. And there's information as to what that percentage is. And you'll see what's really interesting, because of the way that the plan is calculated and the fact that there's these assets that go with it, and expected assets or investment results, there can be significant swings in the amounts that are reported within those, which is why we have these deferred inflows and up above these deferred outflows related to those plans, where there's pretty significant swings that can happen from year to year. And when that liability is adjusted, there's some offsets, and it gets recognized over the future. And how all of that is calculated and done, and the assumptions that are used are detailed in those footnotes. So I apologize for not going to each of those footnotes. I'm happy to do that, but I'm hoping that a reasonable job of summarizing what those amounts relate to.
And I guess I would clarify, because those footnotes run, I mean, those are, you're right, it was not 12, but 13 and 14. They run from page 36 all the way through, it looks like 48. So there's a lot of information there. And I guess on that one is, out of those footnotes, because there is so much information, for number 13, for footnote 13, is there something we should be looking at specifically in those notes, especially related to potential risk that the district might assume with either of these plans?
I guess as far as the potential risk goes, the district doesn't really have any control. You're either having employees, and the state says you're going to participate in these plans because you're required to. You know, I suppose the biggest thing that you might point to as a district would be that these benefits do cost money, and that they are an obligation that the district has committed to, and there is an impact. And what you see on your primary financial statements and your budgets are going to be what your contributions are in any given year. The risks would be that these plans are not managed very well, but for Idaho, I guess, as far as plans go, Idaho does a very good job of managing these pension or these future post-employment and pension benefits. They are about as well run as you can expect for these types of plans. There are some entities have very drastic swings, and in some states there are districts or governmental entities that are paying a contribution calculation today for benefits of employees that retired 10, 15 years ago, and for a plan that was frozen to new entrants 40 years ago. So that's the potential impact of these plans, which is why one of the reasons the standards require this implementation is so that more people are aware of the impact here. But as far as a risk to the district, there's no difference in the risk today than what the risk was 10 years ago. It does, the risk is, what does the Percy board look to in terms of what they're going to require for contribution amounts? And that's but that they look at that every year anyway.
Okay, and I'll just open it up just to see if any of the other board members have any questions, or we just proceed, you know, as we maybe through to the next, to the section after the notes, this first set of notes.
I've just been kind of slowly scrolling through this, and not to ignore what you're saying or to cause everyone to be a little dizzy, but more to drive to the point that you were making, Margaret, that there is a lot of information. I just finished going through footnote 13, which deals with those two post-employment benefits, the sick leave and the insurance. And then this is the pension footnote, almost all of which is driven by Percy itself. The only thing that really gets calculated on your end is based on your contributions, and as long as you are enrolling in individuals correctly and properly calculating their contribution amounts based on their eligible wages, then you're going to be just fine.
Okay. Any questions from anyone, or just keep proceeding and then we can come back if there are questions
Yeah,
afterwards?
just keep proceeding.
Okay, so required supplementary information probably is the next section you might want to just, if there's anything, touch on there, which is page 51 for us.
So the first thing to look at in the required supplementary information is the budgetary comparison schedules, or schedule, because you just have to worry about the general fund, at least for your district. And what this does is it just takes, here's your revenues by major category, here's your expenditures by function, and then you compare what your original budget is, your final budget, and then what the actual results were, what you actually had that are from the previous financial statements. There were some adjustments to the budget amendments, which is certainly appropriate. There's nothing wrong with doing budget amendments, and difference between the expected, the final budgeted amounts and what actually happened. And don't get hung up on little things like this where you'll see, gee, this line looks like you exceeded the budget. You didn't, in fact. What the state statutes require is they focus on each primary function. So instruction, support services, and then non-instruction programs, and then this other capital assets and debt service category itself. So in total, this is the general fund's budget summarized again, original to final and final to actual. And then the other RSI, required supplementary information, is dealing with those plans that we talked about. This is the insurance plan, identifies what changes took place during the year and the calculation, and what that liability is as a component of total covered employee payroll, which is, about 5.3%. The liability is as a component or a ratio of total payroll for the district related to the insurance plan.
So just quickly on that one, and this may be a stuffy question, but I noticed at least even from 2018 down to 2022, it looks like the state may have assisted in there because there was quite the drop in the liability from the beginning of the year from 2018 to 2022. Do you, and quite a bit, the liability percentage, that it dropped quite a bit from 13.49% in 2018 to 5.27%. Is that a question that we should be asking internally here? Why there was, I guess I'm just wondering why there was a change. Do you know offhand?
I apologize. I'm hoping that I heard you correctly. I mean, yes, this is consistent that we're seeing across the districts that in terms of this change. I think the big thing was some of the changes in some of the accounting and how things were done and accounted for. You'll actually see that some of these previous years, didn't have that information because the standards didn't require that. And as they implemented these new standards, you'll see they started to improve some of the things as a result of and just some of the changes in how things are accounted for primarily. That's the biggest difference.
Okay, so that explains the difference. Okay, because it was quite a bit of a percentage drop when I was looking at it.
And then the other schedules are dealing with the sick leave, and this because it's funded with Percy, and there are investments. This is a funded plan. The sick leave is a funded plan, and it has historically been it shows it's a negative number, but that's actually an asset is what it is. It's negative because typically these post-employment benefits would be a liability or an obligation, and it's actually sitting in an asset situation where there's more assets than there are liabilities under the sick leave plan. And this is a proportionate share allocation. In fact, that's what this number is right here. You have a 0.4187% of the total participating entities throughout the state. So a pretty small percentage, but within that plan, that's your proportionate share of it, which is similar to what we kind of get to on the net pension liability information. And when I say similar, the approach is similar. And the reason why your number is actually smaller on the net pension liability than it was on the sick leave is the sick leave is primarily related to school districts, whereas the net pension, the pension is available to all types of governmental entities. So once you add in make it a bigger pie, your piece becomes smaller. So that's why this number here is smaller than what we just looked at, even though this is also under Percy. And what you'll see, what's interesting, and you don't see it now, but because when you do your audit, your fiscal year is June 30, 2022. Well, June 30 is the same year that Percy uses, but because their information is not available soon enough, the standards allow you to go back to the information from up to a year ago. So the net pension liability for Percy is valued or calculated based on the prior year's Percy results. You wouldn't know this necessarily, but now that they have completed their June 30, 2022, they have gone from a funded status of just over 100%, which is the best that they've been, to a funded status of about 83, 84%. But that is because of the significant decline in market that has occurred over the last year for various reasons, and that happens across the board. So as a risk that you can't control, the numbers will change significantly for next year. But as you can see, that liability kind of jumps around as it is. Even though your proportionate share doesn't jump around, and in fact actually has continued to decline as more entities become participants in the plan.
Okay.
Sorry to go through all that, but hopefully I didn't confuse the issue too much.
No, I don't think so. I don't know if, I'll stop again and see if the board has any questions. Okay, keep going. Just making sure. Thanks.
All right, so I think that, as I mentioned, that gets us through the required supplementary information. This is what's called other supplementary information, where it breaks down your funds that are grouped into smaller I say smaller, fewer funds, but more inclusive. So for example, your general fund that's presented in the basic financial statements is actually comprised of several different funds that you track, all for general purposes, but you track them for various reasons that are appropriate. And then the other non-major governmental funds have things like the Child Nutrition Fund, there's a Student Activities Fund, and then there's some state and federal funds. These are broken out separately because while this is local and not state or federal, and the child nutrition, while especially in the current year, is primarily funded with federal dollars, because there's also, especially historically, some local funds that go in there, it's captured kind of separately as well.
So
But then the state and federal funds are broken out in detail.
A quick question on that receivable up on the prior page really quickly. On that receivable of 1.3 million plus, that's at the end of June 30th. Was that, I think I've noticed that non-major federal was considered, ESSER money was considered non-major federal. Is that what that, was that pending receivables for ESSER money? Or what, do you know what that was by any
Not just
chance?
ESSER, we'll look and you'll see, this is the breakdown of all those receivables, okay? This has to do with essentially a lot of the funds, during a period, especially the latter half of the year, the district had not been submitting for reimbursement for eligible expenditures, which took place subsequent to year end. You're entitled to those monies, but you hadn't requested or received them year end, and because you're entitled to those funds, because you were awarded the the dollars and had spent the dollars in accordance with the grant, you're entitled to receive them. So you record a receivable for those expenditures that were incurred, and that's why. And there's such a large number, but yes, ESSER is a big component of it. There's almost $500,000 related to ESSER 3. There's another 180,000 for ESSER 2. ESSER 1 is a smaller amount, 57,000. But then there's also, you'll see there's some significant amounts for Title 1 and Title 6 are the other big ones.
Okay, no, so it's page 61, that receivable on 61 goes down to what is spelled out on 63. Looks like, okay, got it. I should have known that.
Yes, this information here rolls into the total
That number.
within this column right here.
Right.
And 62, page 62 is what rolls into this column here. Sorry, this column. Okay? And that is the balance sheet, assets and liabilities, and then you get the same information for revenues and expenditures.
Okay, so I guess keep moving. I think we're getting, unless anybody has any questions, anyone has questions here, maybe go through the compliance reports, move on to those.
Yeah, that really takes us through all of the financial information. Then we get to the compliance reports themselves, and as I mentioned, there are two that we provide, one dealing with internal control over financial reporting and on compliance as it relates to the financial statements. As I mentioned previously, we don't audit internal controls, we don't issue any opinions, but if we identify any deficiencies that are of a certain magnitude, we're required to report on that. And those are referred to as material weakness, which is defined here. Material weakness is a deficiency or a combination of deficiencies in internal controls such that there is a reasonable possibility that a material misstatement of the entity's financial statements will not be prevented or detected and corrected on a timely basis. So what that's saying is, as far as the difference between detected and corrected, there are different types of controls. You have preventative controls, which are designed to prevent misstatements from occurring in the first place. And then there are detective controls where, okay, look, something took place that we didn't intend, but look, we've identified it, we've corrected it, and now it's fairly stated. As long as those things are done on a timely basis, then there's not what would typically be a control deficiency. So again, preventative controls are ideal, but much more difficult to implement and certainly are more expensive to have a high level preventative controls. And so detective controls are usually what happens, such as reviews and oversight and reconciliations. Those are usually done after the fact and are the primary control objectives that you would utilize. And we did identify, sorry for all that, but as the end of the story is, we did identify a material weakness in internal control as described in finding number 3. This is a required format in terms of the finding presentation. Government auditing standards requires this is the fiscal year that's under audit, and is it finding 1, 2, 3, etc. What they've got 3 digits that they require I would hate to be the entity that uses 3 digits for reported findings, but nevertheless, that's what is required for that. There are 2 significant deficiencies, and this is a real vague definition. It's less severe than a material weakness, yet important enough to merit attention by those charged with governance. It's a vague definition, but the standards are quite clear as to what should be considered as a significant deficiency, or as a strong indicator of a significant deficiency, or possibly a material weakness. So there's a lot of information that we use as auditors to go through and, gee, this is something that came up. If this happens, then yeah, it probably is a significant deficiency, or if this situation exists. And those are described in detail in those findings 1 and 2. If there are compliance or potential compliance related matters that could have could result in a material misstatement or have a material financial impact on the entity, then we're also required to report on that. We did have what we refer to as a compliance finding that, while it did not have a financial impact, it could have. So that's why it goes into this report on compliance and other matters. It's actually related to the federal awards, but because those federal awards are part of your financial statements, then that's why that gets included in this report as well, on that particular finding. And then we'll skip, well, I don't want to say skip. This is, I'll highlight this. This is what's referred to as your schedule of expenditures of federal awards, commonly referred to as a CFA. As we described previously, whenever you expend more than $750,000, you have to have what's referred to as a single audit conducted, and we did that audit as well. And we'll look at that report. These are all the federal awards and the amount of expenditures related to each of those awards. You'll see that some of them have multiple awards within the same grant, and it's just because you've got different years and your awards carry over more than just 1 year in some instances. Not all, but in some instances. So that's why those, and then there are some that are so closely related that they're considered to be what they call a cluster. In the child nutrition, virtually all of the information that goes, all of the federal dollars that go into the child nutrition fund are part of a single cluster, and that's why they kind of get grouped together over here. And then we get into the next page is these non-routine federal dollars, and I say non-routine. The other ones on the previous page are things that you get year in and year out, and you have for a number of years. The COVID-19 related awards, grants are, certainly I'd say a windfall, but there's a lot of dollars that go into here that aren't necessarily routine. Some of those dollars were also on the previous page, but if you see COVID-19 in there, then it's likely to not be there for more than the next couple of years. All right, so the other report again is dealing with the single audit, the federal awards, and that's what this report is. And the single audit is looking at 2 things. One, the actual compliance. Were you in compliance in accordance with the programs that were subject to being tested? We don't test all of the programs. In fact, we only tested 1 program, but it had a lot of dollars, the ESSER, which really has 3 programs in it, but it's really considered 1 for federal purposes. And no issues with compliance, but then we also have a report on controls over compliance. So that's the other, when I skip forward a little bit more, the report on internal control over compliance, we mentioned that there were 2 findings, 2 deficiencies in internal control over compliance that could have resulted in a material misstatement or material non-compliance. Sorry, let me correct that, material non-compliance. They didn't, but they could have. And then, of course, there are the actual findings themselves. So, but I want to pause for a minute and see, do you have any questions?
It looks like no, so go ahead and proceed, thank you.
Okay. So I guess you have had a chance, we have gone in detail with the findings with management and board representation, not the full board. I'm happy to summarize each of these if you would like, or if you just want me to address specific ones, or if you've got questions that you want me to focus on. I want to leave that open and be respectful of your time.
I think it'd probably be best if you could summarize quickly and go through. There's only a few pages, it would be probably best so the people who are sitting here also, besides the board members, understand.
Sure. So the finding one, and this has not always been this presentation, and it's not required, but I think it is helpful. So this finding one is dealing with the financial statements and was considered to be a significant deficiency. This is similar, in fact, virtually identical to findings that we've had in prior years, and it deals with the fact that you're a small district. Okay, you've got a small staff size, and specifically the finance department that deals with the financial information is a small department, which of course is what you would expect given the size of your district. But because of that, and because there are a limited number of individuals, you have what we refer to as a lack of segregation duties. Being able to implement and have controls throughout the entire process is, I don't want to say impossible, but it's pretty close. It's very challenging, and in many instances, I would say might be impossible given not just the size of the organization, but also the resources available. And it's appropriate for you to implement procedures to the best of your ability, but then to also recognize that you aren't going to necessarily put a bunch of money into having better segregation of duties if it doesn't necessarily provide a significant benefit. But that's what that finding is primarily about. And there are some things that have been done over the years and continue to be done to help offset those challenges that you have. The next finding, number 2, is dealing with the accounting for new funds. And as we talked about, you had some new funds dealing with, you mentioned ESSER, there were 3 awards, and there were other funds that came in through acts or decisions made from the governor's office. And as a result of those, and then some additional standards that took place in the prior year, there's new funds that were required to be separated. Each time you have specific restricted resources, more often than not, that's required to be established into a separate fund, which is really just a set of separate, basically its own trials, a self-balancing set of funds or accounts, to track amounts related to specific resources and their available funding. And that's what and there were some instances where there were some amounts that did not get captured correctly between those funds. Ultimately, the way that they're presented, they're correct, but they weren't initially, and that's what this finding relates to. And what's important is when it's the auditors that identify those, it is almost automatically considered to be a finding, because we can't be part of your internal controls. We can certainly assist in some areas when there are questions, but we can't be part of your system of controls. The next finding, 03, is what we refer to as a material weakness. And a lot of this is dealing with significant turnover that took place within the district's business finance department, and what might be summarized as a lack of sufficient training and oversight in that transition. And there were a lot of there was a lot of information from previous individuals that were in those positions that did not get transferred adequately to the individuals that are in those positions now. And as a result, there were a number of adjustments and corrections that needed to be made in order for the financial statements to be fairly stated. And because of the amount and the quantity that were involved, it was almost automatically met the requirements for it to be considered a material weakness. So each of these findings, and I'm sorry, I should have mentioned this, but each of these go through and describe what the condition was, what the standards require, that's the criteria, what's the effect of the condition, is what the next little section is within each of the findings, and then what caused that, what's the result, or why did it happen, and then we provide a recommendation, which in some instances is very simple and straightforward, and sometimes it's a little bit more detailed. And then management has the opportunity to provide a response as to their understanding of the finding and what they expect to do to resolve the findings in the future going forward. So those are dealing with the findings on the financial statements, and then the next two findings are related to the federal dollars. Even though the reality is they kind of go hand in hand, they kind of go together, with the exception of the fifth one, the fifth finding. So this here, dealing with compliance, is, it kind of goes